So welcome for joining our webinar with Zero to One Strategic. I'm Melissa Bouvier. I am the Innovation Partnership Director at Deep Tech Canada. If you're not familiar, Deep Tech Canada is a national nonprofit supporting the deep tech ecosystem. We work on a number of different ways. We support the regional ecosystem by connecting and leveraging different resources within those local ecosystems. We work on a national level. Where we organize conferences and events, namely Quantum Days, which is upcoming this February in Victoria. And then we also support international market access through our trade missions and our international partnerships to support innovations and innovators so that they can stay and scale in Canada. And then our partners here today, Zero to One Strategic, they help Canadian companies maximize their R&D investments and secure non-dilutive funding with a 99% plus success rate on their SRED claims. To date, they've secured over $170 million for their clients, and they have decades of industry experience. They offer a no upfront fee model, and they go beyond traditional consulting to act as a funding partner for deep tech innovators. So with that, I'm going to hand over the floor to Ronen.
Thank you very much, Melissa. It's a pleasure for me and my team to be here. Joining me from my team is Lindsay, who is our VP of Partnerships, and Lana, who runs events for us. We're really excited to be here. Lindsay, did you want to say a few words before I get the ball rolling, or am I good to go?
I'm happy for you to just jump in. Go for it, Ronen.
Okay, fantastic. So what I'm going to do today is I'm going to be sharing my screen and going through a bit of a presentation. Typically, I like to do presentations in person because that allows for better engagement. So what I'm hoping is that if I'm going through my presentation and a question pops up, that you raise your hand and I'll call on you to ask your question. I'm happy to do Q&A time at the end as well, but if you have a question that comes up during the presentation, you're probably not the only one with that question, right? So feel free to jump in. I'm happy to make this a bit more interactive. Okay. All right. Now with that, I'm going to share my screen. Is everybody able to see my screen?
Yeah, looks good.
Okay, fantastic. And everybody can hear me well, yes? Okay, great. So here are the broad strokes of the presentation that I'll be given today. I'll start with a little bit about who I am and my story. I'll talk about the various players in the ecosystem and what each of the players is looking for. We'll discuss high-level non-dilutive funding strategies. We'll discuss the reforms to the SHRED program because I know for many innovators in the country that's quite topical. And then we'll discuss some more nuanced, intricate opportunities, including consortium opportunities at the end of the presentation. I will note my expertise is in strategy, high-level strategy, and on my team, I do have specialists in each one of these areas. So there may be a few questions, if they're very nuanced and detailed, that I will have to refer to some of our specialists. So a little bit about me. I'm the founder of Zero to One Strategic. I'm a serial entrepreneur. I immigrated to Canada when I was 7 years old. I am the son of a mechanical engineer and an architect. And when my parents came to Canada, unfortunately, they were educated in the former Soviet Union, so their degrees were not recognized here. And so I was raised in an environment where my parents were figuring out ways to make ends meet as they were bringing my brother and I up. And eventually they made enough money to start a business and build their company and had a successful company. And so I grew up in that environment. And one thing that my parents always taught me was that you never know what will happen in this world. And so make sure that you're building your own base for yourself, build your own dream. So they were always encouraging me to start my own business. I Went to Western University to the Ivy Business School, where I got my HBA with a specialization in finance. And while I was in school, I was already starting companies. So I've built numerous companies in health tech, biotech, media, prop tech, hardware, B2B and B2C SaaS. For these ventures, I've raised over $20 million. But what I'm actually most proud of was the fact that I was able to leverage that funding that I raised to attract more than $7 million. And the number's actually higher. It's close to $9 million now, in non-dilutive funding from various industry and ecosystem partners, to extend our runway. And for an innovator in Canada, that's very important, as you'll see in the presentation. I also, in my career, have had 2 exits, one to Canada's largest media conglomerate, and the second exit to the world's largest fertilizer producing company. One of the key lessons that I learned, was that specific to non-dilutive, there are lots of opportunities, but to pursue these opportunities and to manage these opportunities, if you do win one of them, is a full-time job. And so when I sold my last business in 2023, I was doing a post-mortem and analyzing how much time I spent on what activities. I was running at that point a 50+ person company, and I realized that I was spending more than a third of my time managing funding. And so with that insight, I decided to start 0 to 1 Strategic. In terms of the ecosystem, there are 4 key players. So the first are the 3 Fs: family, friends, and fools, right? This is typically the first money that you will get into the company. It's typically not large amounts of money. It's just enough, starting capital for you to be able to build an early stage MVP. And the reason, and this funding is relatively cheap, so you don't have to put in too much effort to get it. Most of the time, people are investing in you rather than your business. Especially these are individuals who, for the most part, have known you for a while. Next, you have angels and VCs. There's 2 different classes. Oftentimes, people think of angels as unsophisticated and VCs as sophisticated. Believe me, I've seen angels that are extremely sophisticated and VCs that are very unsophisticated. So there's the whole gamut there. Unsophisticated investors are looking for a cool idea, a smart team. They may not really know the economics of your industry or what you're building, but they believe in you, and they're willing to invest in you. And sophisticated investors they have a deeper understanding of the economics of startups, and they realize that the majority of startups fail. So they are looking to invest in startups that are going to give them a 10 times or more ROI on their investment. So if you are approaching sophisticated investors, that's something that's super important to keep in mind. Don't waste your time if your business isn't the type of business that you think can give investors a 10x return. Next, there are banks and private lenders. Lots of founders avoid this route because this is relatively expensive. Debt carries interest that needs to be paid, and so for a cash-strapped startup that's that's burning capital, that interest and the need to repay it can be problematic. So that's why I said that it's expensive. However, depending on your company structure and what your goals are, this type of funding might make sense. For all my previous ventures, I took angel and VC money. For the company that I'm building right now, 0 to 1 Strategic, I elected to not take any angel or VC money because my priority was keeping my entire cap table clean. And I instead took debt for strategic projects that I was very confident I can get an ROI on. And lastly, but not least, are the non-dilutive funding ecosystem. And this is where we really specialize. This funding is accessible. There are hundreds of funders in Canada, provincial, federal, municipal, private, semi-private, public, that offer thousands of various programs. So there's lots of programs available. However, these programs are often, it's time consuming to identify these opportunities, and the opportunities themselves are non-guaranteed. We've spoken with many prospects and now clients who approach us saying, we've submitted hundreds of applications and we're lucky if one or two of them make it. And they spend all of their time applying for these various programs instead of working in their business. So that's, again, one of the main reasons why I decided to build our company. We are very intentional in what sort of opportunities we pursue, and the ones that get the best advertising aren't always the best ones to apply for. Those are the ones that are typically most competitive. And as a rule of thumb, if a program has lots and lots of attention, it's likely to be oversubscribed and very difficult to actually get funding from. So why does the government make all of these programs available? Every year, there's more than $10 billion in grant programs, just grant programs, that are available to individuals and businesses operating in Canada. Well, they have a few goals. They want to make sure that they incentivize innovation and IP creation. They want people in Canada to be building intellectual property that they can build companies off of, that can hire Canadians and reduce the brain drain that we've been seeing for a very, very long time. We've got some of the best educational institutions, very smart people, but Canada does lose a lot of its smart people to other countries that offer great wages and other benefits. This is the government's effort to help innovators keep these individuals in Canada. If more of these high-paying, intelligent individuals stay in Canada, they're earning higher wages. Their wages are taxable, and so these taxes are collected by the government, and that keeps the whole engine going. So that's the government's incentive to put together and execute a lot of these programs. Any questions so far? Okay, terrific. So we've talked at a high level about the three, there's three key pillars. There's equity capital, venture debt, and non-dilutive funding. We're going to focus the rest of this presentation on non-dilutive funding. There are three main segments to the non-dilutive funding ecosystem. I will first talk about tax credits, and then we'll talk about grants and subsidies. So tax credits are credits that are available to companies at the end of their year when they file their taxes. So there are a few schedules that can be put into your tax return, where as an innovator, you're able to request money back from the government for activities that you undertook, for expenses that you incurred in trying to discover new knowledge or build new products in the country. The most common tax credit that's going to be relevant for this group is the SHRED program, or SR&ED, which stands for Scientific Research and Experimental Development. With this program, you're able to get up to 60% of the expenses that you spent back. So if you spend $1 million on research and development, if you're strategic and intentional in putting in your SHRED application with your taxes at year end, you should be eligible to receive about $600,000 back, which is a pretty substantial incentive. A great thing about the SHRED program, and we'll talk about this in the next slide or two, is that it's going through a reform, which will officially be announced, the details of that reform, in the next month or so, which makes the program more accessible for various types of individuals and businesses. And the next two are subsidies and grants. Subsidies and grants are opportunities that are available forward-looking. So rather than having to wait until your year is done and filling in a few schedules within your tax with tax credits, for subsidies and grants, these are engagements directly with the government agency where you're pitching the agency on a project or a type of work that's going to be undertaken to try to hit some of the government's target areas for innovation or research and development, right? So subsidies are incentives for companies to hire new individuals into their companies. They're typically incentives to hire youths or marginalized groups. And they can make up to around $30,000 per hire available, depending on the program. And we've seen as much as 80% of a candidate's wage be covered. So if you're spending $40,000 on a new hire within one of the target areas that the government has, you can get $30,000 of that back as long as you're approved for that subsidy ahead of time, right? What's really important is that you need to be approved for grants or subsidies before you incur the expenses. What we see frequently is companies who think they're going to get this incentive and they hire and they spend the money. But without that guarantee, without knowing that you're going to be getting that subsidy, it's unlikely that you'll be able to recover that cost after the fact. And grants are similar to subsidies in that they are forward-looking. But a key difference is that for grants, they are project-based and they typically allow for expenses above and beyond wages, right? So there may be materials expenses, there may be subcontractors that are allowed for grants, and they tend, for the most part, to be larger than subsidies. But that's not always the case. So grants and subsidies, forward-looking, you need to submit an application and be awarded with the opportunity to incur these expenses that will be reimbursed. Whereas tax credits are at the end of the year. One thing to note is that if you are being awarded both grants and subsidies and tax credits, there are risks of grind downs and cannibalization. So it is very important to be intentional in your funding strategy, and I'll repeat this again later in the presentation, to make sure that you don't get your credits clawed back. Let's talk a little bit about the SHRED program and the proposed reform. So in 2024, the Canadian government spent about $4.5 billion in incentivizing companies operating in Canada to do research and development and acquire new knowledge. In 2025, that's projected to be north of $5 billion, and 2026 onwards, it's projected to be north of $6 billion. So there's significant investment going into this, and it's because, again, Canada is trying to battle the brain drain and to incentivize individuals and groups to set up companies in Canada. There are some reforms that were announced on December 16th last year by Chrystia Freeland. They have yet to go into effect, but we expect for them to go into effect with additional government guidance before the end of this year. Some of the big changes are that capital expenditures, which were accessible to companies, refunds on capital expenditures were accessible in the 90s, and then they were taken away by the program. They're now going to be allowed again. And so there are certain expenses that many of you are likely incurring, especially if you have capital equipment, if you have an advanced manufacturing business, or you're producing widgets, the equipment that's being used, whether it's bought by you or leased, should be eligible for refunds, as long as that equipment is being used at least partially for research and development and not just for commercialization. And the refund rate on that is about 40%, which is not insignificant. Second, CCPC, so Canadian controlled private companies. The limit in terms of what they can claim for refundable credits is also growing from 3 million to 4.5 million. And so that's a really big change. Prior to this, the maximal refundable credit that a Canadian company could get, depending on what province they're in, was around 1.2, 1.3 million. That's growing to almost 2 million, which is really substantial and impacts a lot of CCPCs. For those of you who don't know what a CCPC is, that's a Canadian controlled private corporation. It means that the mine management and control of the company is in Canada. So effectively, more than 50% of the voting shares are Canadian. Next, the taxable capital allowed is also increasing. So if a company has historically between 10 to 50 million dollars in taxable capital, there would be grind downs on how much of their credit would be refundable. That's growing to 15 to 75 million, and that's linear, right? And for those of you who are curious about what qualifies as taxable capital, the simple formula is equity plus the cash that you have on your balance sheet, less investments and loans out. That's the quick and dirty formula. There's nuance to that, but that's the quick and dirty formula. And then finally, a really big one is for publicly traded companies. They're now able to get refundable tax credits, much like CCPCs, and so that's a recent change, and that's we've never had that in the SHRED program before. But I don't really think that will impact any other companies on this call. Beyond SHRED, let's go into non-dilutive, other non-dilutive programs, so grants. Grant programs come in all different shapes and sizes. Some come and go, and others are evergreen. Even the ones that are evergreen, year to year, and even quarter to quarter, they will change oftentimes their focus area, right? So one quarter, they can have a focus on artificial intelligence as an enabler. Another quarter, they can have a really big focus on clean tech, right? So it's really important to keep an eye out on the various programs and what their focus is at any given point in time. A recommendation that we make to our clients is to build a non-dilutive data room. Oftentimes what happens is that if a company is interested in applying for a grant, they will, if they have historical grants that they've applied for, they will find those, they will copy and paste things and quickly try to put them into the new application and massage them to fit. But we find that takes a lot of time and effort, and that is seldom successful because you have different versions of files floating around with different information, and it's very easy to make mistakes. So our recommendation is to build a non-dilutive data room, much like you would for investors, but build it for non-dilutive funders. And that is a place where you can access your historical applications. You can keep notes on what was successful, what wasn't successful. And that's one of the services that we offer. And then beyond that, it is very important to be intentional rather than spraying and praying with these applications. Do your research, get to know the funder, build a relationship with a human on the other side of the aisle. So within the funder's organization, try to get in contact with somebody who's going to give you candid feedback, because oftentimes government agencies are a little bit behind in terms of posting information online about when programs open or close. There are some programs that open up and they run out of funding within the first few days, but they don't update the website to say that there's no more funding available, and they still keep receiving applications for months after the fact until they finally officially close the application. So that's why it's really important to have contacts on the inside within whatever organization you're applying for to significantly increase your chances um, and decrease the amount of wasted effort. So next, let's talk a little bit about consortium opportunities. There are many consortium opportunities, and typically the most lucrative opportunities are ones where it's not just one company that's applying for a grant, but rather where a group of companies who have aligned missions and visions are coming together to undertake a larger project. Consortium opportunities are typically in the 7 to 8 figures, so very substantial, and they're meant for more mature companies, although we've seen numerous times where some of our smaller clients are able to become a part of a consortium that includes larger companies. Um, these consortiums range and have a wide range in terms of what their target focus is. And there are several organizations like the ones that you see up on the screen that have these available. Much like other grant opportunities, some of these are evergreen, and some of these are they may come up one day and then never again. So it's really important to speak with the organization that is awarding the funding and understanding what types of companies they're looking for before putting together an application. Another area that I would strongly recommend is to make friends within your industry and with adjacent industries that you feel could become good consortium partners. This is one of the main asks that our clients have of us. They feel like there's a consortium opportunity that is built for them. They're a perfect fit, but they don't have enough partners that are ready. And so we spent a lot of our time looking for partners. It's easier. It makes everybody's life easier if you're actively going out and making friends with various players in the ecosystem. And beyond consortium, there are other opportunities. I'm not going to talk too much about Deep Tech's R&D initiative that is set to be announced. I'll leave that to Deep Tech. But there are several agencies that are offering large grant funding opportunities, and they, much like every other grant, have their unique focus, and the rules for engagement with these various opportunities are the same, right? Make sure that you have a relationship with somebody at the organization, identify opportunities that may be coming down the pipeline, rather than just the ones that are currently active. Anecdotally, and this isn't true for every single program that's out there, but many programs, I would say even the majority of programs that are announced, where there's a substantial amount of funding, the majority of the funding has already been earmarked, either hard or soft earmarked, when those applications launch. And that funding is earmarked for organizations who got in contact with the agency early on. They were identified as somebody as an entity that could be a good fit for a project that's coming down the pipeline. They were able to get early access to an application that maybe wasn't finalized, but when they got early access, they were able to put together an application and iterate on it. They had a lot more time to iterate on it. They had the opportunity to get feedback from the agency. So by the time that program opened up, they have a near perfect application ready to submit, and they're first in line to get reviewed. Right? So that's why it's really important to build those relationships. So high-level recommendations for innovators in Canada. Backwards looking, especially with the changes to the SR&ED program, it's important to look through your expenditures over the past year and see if you may qualify for enhanced refunds, especially with legislation that's set to come into effect relatively soon. Beyond that, for all types of non-dilutive funding, plan ahead. We see a statistically significant difference in terms of the amount of funding that companies get when they are intentional and begin planning for their non-dilutive funding at the beginning of the year rather than at the end of the year, right? We have clients that come to us all the time at the end of the year and they tell us, this is what we did. Help us figure out how to get the most amount of money. At that point, oftentimes they've already committed to certain things. They already have contracts with government agencies that say they're going to be funded for a certain type of work. And when we're applying for a tax credit, it's very difficult to carve out a different work. Whereas clients that we work with early on and we help build that strategy, we are oftentimes very successful at being able to carve out different areas for expenditures so that more of their projects get funded, and there are fewer clawbacks from overlapping work. We don't have to talk too much about the publicly traded companies, but yeah, and I discussed the be strategic point already. And then finally, you may get lucky if you're applying for one-off opportunities that pop up, but luck isn't the optimal way to build a company. So be intentional, be strategic, plan, have non-dilutive funding as one of your key pillars for cash flow management. Build relationships with funders, as I mentioned, and have given numerous anecdotes about. And like the example that I gave earlier about how after I sold my last company, I did a postmortem and looked how much time I spent. It was more than a third of my time spending on identifying and applying for and managing these non-dilutive funding opportunities while I was able to get a substantial amount of capital into the company. I wish I had a partner that could do that for me so I didn't have to spend that time and I could instead invest that time into building and growing my company, because I'm sure that I would have been able to get higher exit multiples. Even though I'm happy with my exit, I do believe that it would have been larger had I had that time back. Okay, thank you very much. I would be happy to answer any questions anybody has. And I've taken the presentation off my screen, but if there's something specific that somebody wants to refer to, I'm happy to pop it back up.
Any questions, anyone? Sean?
Sean, yeah.
Hey, thanks for the presentation. Appreciate it. I came in late, so I might have missed this at the start, but I was just curious if you could share a little bit more about 0 to 1's business model. I'm guessing it's like other shred agencies I've heard of where it's a cut or something like that, but I'm curious what you could share there.
Great question, Sean. So wherever possible, we'll do contingency-based work because we feel like that really aligns us with our clients. There are some government agencies and some programs that don't allow for that. And where there are programs that don't allow for that, we have a really candid, explicit conversation before we engage in doing any work with a client and give them a few options in terms of how they want to move forward. And again, our focus is on making the pie bigger, right? We really have an intentional lens on identifying all the different opportunities and figuring out how to execute on them to maximize the benefit for the client. We would way rather take a smaller fee because we believe that we will make more money if we win more money for the client, fundamentally.
Cool, that makes sense. I have a deeper question that may be more appropriate for a follow-up call, but if nobody else has a question, I'll ask it. But I'll just give it a second.
Sure. Thanks, Sean.
I think you could probably go ahead.
Cool. I'm co-founder and CEO of a space startup, so very heavily deep tech, longer term pipelines. And so our approach so far has been to rely on non-dilutive funding. I'm curious, and I expect I know the answer, but I'd be remiss if I didn't ask. I'm curious if you have any specific experience or advice for when to approach investors, and more specifically, how to narrow the I guess fire hose of investors that aren't the right fit. So a bit of the background is that I'm consistently running into the problem where most VCs or even angels want at max 5 years turnaround time before they're able to exit. And for we're looking to build software to do lunar missions. That it's just that's the time when we're going to be starting to hit profitability. Probably is going to be in 5-ish years, especially at the growth that a VC is going to want. And so that's something I've really been struggling with is how to decide either when to put in the effort or how to do the due diligence without, as you said, killing all of my time building the business, just chasing down a yellow brick road that might not ever end.
Terrific question. Really, really good question. And a question that we get asked in a variant of daily, basically, from our clients. It's true that not every funder will be willing to fund you because oftentimes, and I did mention this early on in my presentation, especially sophisticated investors that are going to be investing the sizes of checks that you're looking for are looking for a 10x return, and they're looking for it relatively quickly. But that's not universally true. There are some investors that are looking to put money behind innovators who are going to fundamentally change the rules of engagement for whatever industry that you're in, right? And that sounds like what you're trying to do. So I would look at investors that have historically invested in true 0 to 1 initiatives that, and they have a dedicated fund for that, right? I have a few in mind that I'd be happy to share with you offline, actually, based on some previous engagements. But yeah, it's true that not every single funder will be the right funder for you. And if you don't see that a funder is invested in like swing for the fences projects that are unlikely to pay out in the next few years, that are much further looking ahead, don't spend your time approaching them.
Thanks. I appreciate that. Cool. And yeah, do you have your email, or should I just use the sales at 21? I've looked up your website. So or
I think my email is Ronen, RONEN at 0to1strategic.com. But my presentation, I'm okay with my presentation being mailed out to the group afterwards as well. And it's in the presentation.
Awesome. Thank you.
My pleasure. My pleasure.
Okay, Jenilyn, I think you can go ahead.
Thanks, Jackie. Thanks for the presentation there, Ronen. I'm the manager of a deep tech incubator at the University of Saskatchewan. And so one of the things that our founders usually ask for is when is the right time to apply for funding and the type of funding? And we typically say, the earlier the better, of course. And, I totally agree with you in terms of developing those relationships. But I wonder, because you talk about how you need to plan and you need to plan ahead, is there a certain time throughout the year when a lot of these non-dilutive funding opportunities do come up? So, I've seen, for example, like in the spring or more so in the fall.
Great question. Great question, gentlemen. And thank you for that. So the federal government's year end is March 31st. And so a lot of funding is made available to these a lot of funding is made available to these organizations, to the they're made available at the start of April. So there's typically in the spring between April and May, there are many different opportunities that come up. And then the money that isn't used up is oftentimes made available again in September, October, right? Because oftentimes they make money available, they make several awards, and then there's another sprint in the early fall, to use up the remaining money. That's the general trend, but it's not universal, of course, right? Because there's some programs that that fund companies once a year, let's say in the winter, right? Some entities. Really depends. In terms of when companies at the very early stage should apply for funding, my recommendation, after being through the ringer several times, is to not start too early. That actually is really important to note, because there are fewer opportunities that are available to companies that start really early. The funding amounts are smaller. The amount of effort is typically significant to get that funding. And they oftentimes, if they were to wait a little bit longer and get a little bit more traction, could have a stronger story for funding. So my recommendation is to get some material traction. Show that there is either some dilutive funding or some reliable revenue on the horizon before putting in these applications. What we've seen a lot of is companies that are pre-revenue, that don't have any funding, that don't have any customers, that have an idea, apply for funding. And unfortunately, that's a recipe for failure most of the time, right? The odds of success there are quite low because there's very little validation. So that's why we say at a very, very early stage, rather than focusing on looking for funding, focus on trying to identify product market fit. Instead, raise your early dollars from the 3 Fs, right? Family, friends, fools. Get a little bit of capital to get that early stage MVP, validate that, and once you have some validation, then apply for grant funding.
Great. Thanks for that, Ronen. Appreciate that. Wish I could have recorded you so that I could play it back for our founders.
I think this is actually being recorded. I think this is actually being recorded. So
Yeah.
maybe we can clip that part and share it.
Thank you.
There's one in the chat from Yasri. It's LTR versus funding. Yasri, do you want to expand on that a little bit?
Hi.
Hi, Asri.
Sorry, I just asked the question. I'm a shy guy. I usually do not interfere. So LTR versus funding, it's level of technology readiness versus funding. It's exactly what you said at the end. If he's still in the ideation phase, forget about funding. There is no funding mechanism here. I've tried almost everything. So level of technology readiness, which I refer to by LTR, if still 0, 1, 2, 3, 4, there is no funder, angel investor who is interested even in meeting you. 5, 6, 7, that's the game actually. This is why they are putting their money. Then you will have no other option other than the grants. Grants takes for eternity, 1 year, 1.5 years. And then, as Ronan said, if you apply by July, you have no room, no budget, like you are if you apply by April and May. So I'm very negative about it. I'm looking for solutions, so I can't advise about anything. So that is what I feel like. Level of technology readiness in your project, in whoever project, is very key to, and depending on who is really interested in funding you. So I was about to ask the second question, which is from 0 to that validation. point, that validation stage, there is a cost because sometimes you are running the thing for 1 year and a half, and what the government is offering or the accelerators or the incubators, call it whatever, they offer you a space. We don't need a space or just a co-working sharing space to do the thing. We need people who can validate the project sometimes with deep knowledge. We need, and especially for solo founders, I'm talking about my self experience, which is we need to know about many things, not only about the main core of the thing, which is to develop the MVP, but you need to know the ecosystem around it. And you need to know every single detail, blah, blah, blah. I'm addressing to Sean. I feel like we are at the same stage. You have a big dream. I used to have a big one. Uh, then I'll stop here. You guys, you can advise better.
Yeah, thank you so much, Yasrik, for your question. So, in terms of level of technology readiness, there are different funding programs that are focused on different levels of technology readiness, but you're right that the majority of funding available is focused on levels like 5 and up. And we see the bigger projects being focused on levels like 7, 8, and beyond, right? So it is important to note that. And another thing to note is, especially for larger funding projects, like core fundamental business building funding projects, typically those projects are multi-year projects that pay out over time. And to apply for those projects, there are several stages as well, right? There's a statement of interest, and then there's the initial stage, and then a secondary stage once you're able to get through that. So there's a lot of effort, and even after you submitted the applications, it typically takes a really long time for the agency to get back to you. And then once you're awarded the project, then you have to incur those expenses over a period of time. So sometimes it takes 2+ years in order for you to see any dollars. That's why it's really important to not have non-dilutive funding as the only source of funding that you're using to build your business, and to use it and to view it as more of a runway extension tool over time. It's important to have more than one, ideally, source of non-dilutive funding as well, right? Some that are shorter term, some that are longer term. And you're right, it takes a lot of time to find these opportunities, to apply for them, and then to manage them, even after you've been awarded them. That's why our company exists. We built this business in order to help cut through all of that noise and that effort so that founders and leaders within innovative organizations can focus their time on building their business and not have to worry about the non-dilutive funding part, because it is a lot of effort. Yeah, Yosri, feel free to ask a follow-up.
And in that case, the companies you will be interested in, given that support, has to be an already established company, not in the sense with a commercial registration, but there will be there are people need to be in place, and my company payroll for me to be entitled even to ask for those grants, non-dilutive stuff. If you are referring to the IRAP, blah blah blah, but even here doesn't work. You are a solo founder. You are bearing the cost or some expenses for licensing or to develop something, blah, blah, blah. But they want you to hire an extra minimum one researcher full time for me to be eligible to submit my application for a 50K, for example, a non-dilutive grant. So I was stuck there. This is why now I sound a little bit pessimistic. Sorry. But I was stuck there. I tried, and then I'm trying to enlighten also the other guys over there who are founders. So don't trust me 100%. Just take 50%. I'm just trying to tell you where I was stuck. Maybe you can avoid it for your things to push through for the other
Yeah,
solo founders.
yeah, really appreciate those lessons learned, and it's important to align expectations, right, for these programs. Um, as I mentioned, I would strongly advise against putting in any substantial effort in getting non-dilutive funding until you have some staff, until you have some capital in the business, until you have the engine already rolling. And typically, the first money that you need into the company is the founder's money, and then the three F's: family, friends, and fools, to get the project to a state where you have something that you can then tack on some non-dilutive funding to, right? Non-dilutive funding, strongly advise against using it as the first line. It is a runway extension tool. It is not a startup capital tool. And so if you sort of have that expectation where we're not going to use it as startup capital, we're going to use it as runway extension. Once we have some capital and we need to extend the runway and we're able to prove some product market fit, a little bit of traction, then that's a really good opportunity to apply for non-dilutive funding, because you have a story to tell, right? You can say, with our own money or with money that we've gotten elsewhere, we've been able to accomplish this, and it significantly de-risks it for the funder, because the funder is like, okay, well, there's other people that have their money in this already. So, we're the so it's not as risky for us to back it.
Okay, we just have a few minutes left. Is there anyone else who has one quick question? Okay. Doesn't look like there's anyone who has any follow-ups. So I want to thank Ronen, Lindsay, and Lana for their time today. That was really informative. I learned a lot, so that was really great. So yeah, thank you everyone for your time today.
Our pleasure. Thank you very much for hosting us.
Thank you.